Seems like every time we do a video on AT&T, the stock is going down. That is the case again today after reporting Q2 earnings before the bell. What is going on, everybody? Hopefully, you guys are doing well out there. Time to talk about AT&T Incorporated, ticker symbol T, after reporting Q2 earnings before the bell with revenues coming in at $29.6 billion. We'll walk over to these financials and we'll walk you through all the different costs, all the different revenue streams, and the eventual profits over at AT&T. We'll look at the balance sheet, the all-important debt and interest payments that AT&T is paying on its debt. We'll talk about all that and obviously cash flows. We've got to come over here and look at this from a technical perspective. It has been on an absolute ski slope downward and is following through on that today, down over 7% during the regular trade. Now, over the last year, this one's performing a little bit like a bond, kind of how you expect a stock like this to perform. Now, when we get over to the earnings estimates, you'll kind of see bond-like kind of returns on the revenue side where you're having very, very slow growth over at AT&T. Now, over the last year, down about 10%. Year to date, though, essentially flat, down 1.5%. Again, that's after losing about 7% on the share price today. I remember when this company cut their dividend a couple of months ago when they consummated the split off of the Warner Brother Media division from AT&T's kind of a bread and butter bond-like cash flows and returns from their cell phone and internet business. Well, the yield, everybody was talking about that. Well, that's still at 6.4%. That's probably going to go higher in the coming days the more this stock continues to trend down. Now, we'll jump over to the earnings. Revenues came in at $29.6 billion. That was 17% decline year over year, but a little bit misleading, okay? They did beat expectations on that revenue side by about $130 million. The reason why I'm saying that revenue is a little bit misleading is the fact that from a comparable basis, this time last year, AT&T had $35.7 billion worth of total revenues. This year, just 29.6. Yes, that is a 17% decline. Now, I'm not trying to make excuses for AT&T. I just want to explain this to you from an investor perspective. The standalone AT&T business, which is what AT&T business is left with today at $29.6 billion, that compares to the standalone business that they had a year ago in the March quarter. Now, they had on that business $28.9 billion worth of revenue. From a rounding perspective, you might as well think about this as $29 billion worth of revenue. So year over year on the comparable business, again, this $35.7 billion worth of business last year includes revenues from a company that AT&T no longer has under this umbrella. So if you strip out the Warner Brothers Media business, you go from $29 billion worth of business last year from AT&T up fractionally to 29.6. Again, I'm not sitting here trying to make excuses from AT&T. I'm just sitting here explaining to you this from an investor perspective. I'm sure inside of AT&T's documents, they have adjusted numbers and things like that. I'm almost positive they have to report these financials this way. Somewhat misleading if you're not following this company, if you're not familiar with the revenue recognition of the 35.7 includes some business from the Warner Brothers Media Group, which is no longer a part of AT&T. Now, I don't necessarily think the miscalculation or the misunderstanding of that from Wall Street, I think this stock is pretty well understood. I think what investors are wondering is the fact that they lowered their free cash flow forecast to $14 billion from the previous $16 billion guidance. Now, the company has just $4 billion worth of free cash flow through 6 months. That implies a $10 billion or nearly $5 billion a quarter if it's spread over equally over the next 2 quarters. AT&T is going to somehow come up with $10 billion worth of free cash flow when we get over to the financials and we get over to the cash flow statement. I'll show you that's not that big of a stretch. This company, I think, is going to be capable of hitting that mark, but just keep in mind, they forecasted for $16 billion worth of free cash. Now it's down to 14. That, in my opinion, is probably due to some of the declines that you're seeing with the share price during the regular trade. Anytime you bring that back, that is going to have investors concerned. Now, in terms of the forward guidance over at AT&T, okay, we just had Q2. We're looking forward to Q3, Q4, and then maybe even into next year, the first couple of quarters of 2023. Well, as you'd expect, a cell phone internet company that trades more like a bond, kind of steady investment rather than kind of a rapid growth investment. I mean, we just did 2 videos on Netflix and Tesla, 2 stocks where you'd expect rapid growth. Look at AT&T. They have a 2.9 in front of the vast majority of their revenue estimates for the upcoming quarters. That's $29 billion worth of revenue. In the fourth quarter, they experience a small jump as people maybe switch cell phone plans, get a new cell phone, or gift that to somebody. They see about a $2 billion bump in those quarters, probably more closer to about a $1.5 billion with a bump of revenue. You get up to about $31 billion, but you're between about $29 and $31 billion worth of revenue for the foreseeable future over at AT&T. Now, the year-over-year growth comparison, again, these are analyst estimates, they look really bad for the upcoming 4 quarters. In fact, they're expected to decline over 20% for the foreseeable future. That is because, again, these revenue estimates are including the fact that AT&T had Warner Brothers media revenue to recognize. These estimates are not adjusted. When you look out into the future with AT&T, you will see similar type of growth, where a year ago in the AT&T business, they had $29 billion worth of revenue, and a year later, they have about $600 million worth of more revenue. Very slow growing business, but very steady from a cash flow perspective. We'll show you that as we move through these financials. So we talked about this revenue number, how it's not necessarily comparable. It's basically flat year over year. Now, what is also driving up some of the expenses is you have equipment. So obviously with inflation over at AT&T, their equipment is likely going to cost more. And that's what we're seeing over the last year. That's up 4.1%. They got to eliminate this broadcast programming and kind of operation expenses. This was associated with running the Warner Media business, which is no longer under this umbrella. So last year, obviously, you recognized $3.4 billion worth of expenses. This year, that business is gone. You don't recognize those expenses anymore. You have other cost of revenues. Those are down about 8.6% from 7.4 down to $6.8 billion. Then you have selling, general, and administrative expenses. Those are down. You like to see that over at AT&T. Maybe some of this has to do with the split off. You don't have as many back office staff. You don't have as many expenses because you're running a smaller business. You go from $7.5 billion, nearly $7.6 billion worth of SG&A expenses down to about 7.3. They had some restructuring costs coming in at $631 million, and you have depreciation and amortization. This is a non-cash charge that is basically flat year over year. Total operating expenses in the most recent quarter coming in at $24.7 billion, down 12%. Some of that is skewed a little bit by the fact that last year you had a $3.4 billion charge on that Warner Media business, and obviously that business is gone, so you don't recognize that. That helped drive down the vast majority of operating expenses. So you have lower revenues year over year. Operating income obviously going to be lower as well, coming in at about $5 billion last year. Again, not on a comparable basis. You were closer to $7.5 billion. So some of you might be wondering, how does the operating income of $5 billion compare to last year just on the standalone AT&T business? And my apologies, I know this is super small. They changed their formatting over here. It doesn't look as good over at AT&T, but I do have adjusted operating income. So they've adjusted this number just a little bit, but it was right about $5.8 billion. So compare year over year just on the standalone business on AT&T. You grew revenues just fractionally, and your operating income did slip a little bit, probably primarily due to the fact that you had inflation costs. You also had this asset impairment and abandonment at $631 million. You could probably strip that out, and for the most part, AT&T went from about $5.8 billion worth of positive operating income to about the same, just marginally less year over year. So this stock is performing exactly how you'd expect it to. It's barely growing its revenues. It is profitable. Those are going to barely grow as well. There's just not a lot of levers that AT&T can pull to really grow their business. It's just going to be a steady business over a long period of time. Now, what they need to do is continue to pay down their interest expense, because that is the one lever that AT&T probably can pull. Because you notice in the most recent quarter, they had $1.5 billion billion worth of interest expense. Imagine if you take this $1.5 billion, and not all of this, a company like this always has to carry debt, but if we can continue to whittle this cost down, well, that flows right into operating income and net income more specifically. So you see over the last year, our interest expense over at AT&T actually ticked down. I'll show you when we get to cash flows. This company's done a very nice job paying down debt. Obviously, they unloaded a very valuable business. They used a lot of that cash for that, but you certainly benefit of that from a shareholder perspective. You went from $1.6 billion worth of an interest expense last year down to 1.5. My guess is that's probably going to continue to go down in the coming months ahead. So you pull down to a net income number, you get a fantastic $4.5 billion, because there's some funky accounting stuff here that didn't reoccur year over year, but all things being considered, very nice over at AT&T. And you get kind of a diluted earnings per share at about 56 cents. Again, that's in a quarter. This company is pledging $1.11 per share on that dividend. That's really, quite frankly, why you're buying AT&T, is this fantastic 6% dividend yield. You're getting $1.11 for a full year, and in a quarter that was not necessarily the best for AT&T, but not bad. You're earning about half of that dividend. That is fantastic. They've got nice dividend coverage over at AT&T. Now, from a balance sheet perspective, it looks completely blown up. Look, at the beginning of the year, you had $19 billion in cash. Now you're all the way down to $4 billion. Total current assets went from 170 all the way down to $34 billion because they unloaded essentially $119 billion worth of assets in that sale of Warner Brothers Media. There's probably some other things mixed up in there since the beginning of the year. So you have a far reduced balance sheet over at AT&T, but you have a much more predictable business, easier business to management now that they don't really have a controlling stake in DirecTV. They don't control Warner Brothers Media, and they have to invest all this money in that stuff. Those things look a little bit better. Now, the all-important long-term debt over at AT&T comes in right here at about $129 billion. Notice the big reduction from 151 all the way down to 129. So when you see cash go from 19 down to 4, you better see a big reduction in debt, and that's exactly what you saw over at AT&T. Again, from 151 down to 129. Still a mountain, a pile of debt, but this company probably has the ability from a cash flow perspective to keep whittling that down over time. And whittling, I think, is the proper term. It's going to be a slow grind, but AT&T will likely do it over the longer period of time. Now, we pull down a 6-month period here for our cash flows. We pull down a net income number very close to $10 billion. Last year, you're close to 13.5. Again, not necessarily comparable since you had other businesses wrapped up into AT&T. You slide through all your add backs and subtractions, including over $8.9 billion worth of amortization and depreciation, and you get positive cash flows in the most recent quarter at $15.37 billion last year, closer to 19.7. Now, here's some of the reasons why. We talked about how AT&T cut their guidance on that free cash flow from 14 down to 16. They have just $4 billion worth of free cash flow so far, and so that means they need a strong back half of the year in terms of cash flows to make up that difference. Some of that has to do with the fact you should see a flattening out of the investing activity, kind of cash burn. Okay, capital expenditures are always going to be there over at AT&T. Last year, they were at 7.6. Now you're up to 9.5. But these acquisitions should start to slow down a little bit, at least the cash burn from that. You went from $30 billion flowing out of the company down to 17. But here's where you're going to probably see a lot of improvement in terms of cash flows. Okay, they did a repayment of long-term debt in the most recent quarter at $24 billion. They repaid some short-term borrowings at about $15.6 billion. They obviously still paid dividends, but the total amount that they are paying is actually reduced year over year as well. Notice through these financing activities, again, the vast majority coming from very large debt payments. So they burn through $49 billion. And this is a lot of this stuff I wouldn't say is one time, obviously, when we're talking about dividend payments and paying off this debt. I don't want to call it one time, but these are ballooned and accelerated because they got rid of that Warner Brothers Media. They had a plan to use that cash flow that they got from that into paying off of this debt. This should help reduce the debt services costs that AT&T has to pay. The cash burn from the financing activities should flatten out in Q3 and Q4. That's where I think you'll see a pickup in cash flows over at AT&T. Now, from a technical perspective, there's not a lot to like here. here. The stock has been in a downtrend for basically 5 years. It has peaked its head. I'm on a daily chart with AT&T. The stock peaked out over about $32 per share kind of in 2016 and 2017, and quite frankly hasn't seen that level since. Yes, it's peaked its head a little bit at times. Even more recently, it has popped above this channel. You could draw this channel a couple of different ways. There's probably kind of a secondary, maybe even downward trend line coming in towards the top of the channel. But either way you look at this, this is a downward trend with AT&T, and I would not want to buy it up here at the top of the range. Again, this red line is a signal that sellers are about to step in. Yes, if you do break above this line, so momentum comes, but as we've seen in 3 successive years, the stock comes crashing down after that. Now, we're at the top of this range. This is not where I'd want to buy AT&T. I'd wait for some further red candles to show up at AT&T, pull us down to the bottom of this channel. If it happens in relatively short order, you should retest the lows that we made back in December on this stock, close to $16 per share. Again, we're looking at this from a technical perspective. Is this technical pattern, and there's no reason to think that this technical pattern, which has really been in place since 2017, that it won't continue until it completely does something different. And something different with AT&T would be big green candles. I mean, I'm talking about several candles probably over the course of several months, maybe even over a year, where it starts putting you over the previous highs. In this case, we need to get above 21. I think more specifically, you need to get above this cluster of highs, which really needs to take you up north of probably $25 per share till this trend could be saying, well, maybe this trend is long gone and it's over. I think this trend is still intact. I think red candles are going to show up with AT&T. You pull down here, you start retesting these $16 lows. That would be an area where I'd be interested in buying AT&T. Would not be interested at all buying it 19. Now, complicating the situation just slightly is the fact that you do earn $1.11 per share. That's 6.4% on a yield. Certainly will probably go higher in the coming days. You've got a very low multiple on this one, trading just at a forward PE of just 8. Everything screams that this is a value stock. This is worth buying, but over the last 5 years, that has always been the case with AT&T. The dividend has been high, the PE for the most part, and the valuation has been underneath where you see maybe even other telcos, let alone other stocks, and AT&T stock just continues to go down. I would let it just continue to walk down. If you buy this at a low price and you've got a long-term time horizon on this one, you can collect these dividends, reinvest them, and hope one day AT&T stock bottoms from a technical perspective and has some momentum. If you see any type of momentum in this stock, I think I would join a list of many people that would probably take profits on any shorter term gains with AT&T. Hopefully you guys enjoyed today's video. I'll be back again soon with more. Good luck with your investments.